Hey, welcome back to the channel. My name is Jesse, and today I'm going to be going over Target. All right, let's go ahead and load in Target here. I am going to normalize this on the evaluation side because Target kind of had a little bit of cyclicality between the COVID boom and then the COVID bust from demand pull forward. So we are going to normalize the evaluation on this. Let's jump on over into the income sheet. And when I say normalize, I'm just taking the average over the last 5 years instead of the last year. If we look at the income sheet, we can kind of see the kind of just consistency, not a lot of growth over the last between like 2012 and 2019 or so. And then we kind of had this really good growth over 2020 and 2021, and then came back down in 2022. So they're pulling back from the fundamental numbers. We saw a lot of bottom line expansion over 2020 and 2021, and then kind of regression 2022 as they ordered way too much stuff. Expenses just kind of like growing in line with the business, which is pretty good. EPS diluted, we can see, has been fairly steady, and then we saw this kind of increase and then this bust. So we'll see if this normalizes back to those previous levels. Weighted shares outstanding. They've been buying back shares like crazy. I wonder what this is going to be on a percentage basis, but just looking over the last 10 years, they went from about 662 to 463. So a significant amount of buybacks over the last 10 years. So Target is paying out a dividend, but also buying back shares at a pretty aggressive rate. If we look at their balance sheet, cash and short-term investments is low. Dang. Oh man. So a very small amount of cash compared to their total current liabilities and total current assets. I wonder if that might be skewed from like leases or something though. So total assets, total liabilities kind of stay consistent over here. They're definitely hurting for cash right now, it looks like. Goodwill and intangibles, nothing really to see there. Stockholder equity has kind of decreased, actually, interestingly. Total liabilities and total equity is kind of moderated and then came up a little bit. We go to the free cash flow statement and we can see fairly stable free cash flow, a little bit of a yearly cyclicality over the last 10 years. And then we saw a massive negative drop in free cash flow here in 2022 and a rebound. So capital expenditures, investment property, plant equipment, and depreciation and amortization has stayed pretty constant, or pretty consistent. Free cash flow, net change in cash, huge net change in cash over the first quarter of 2022, pretty large. It looks like that might be, no, that's on different quarters. So I was gonna say they just did a large common stock repurchase right here in this last quarter, but their free cash flow has basically been going down to some debt repayment, common stock repurchase, and dividends paid. So they've been paying a constant dividend, steady dividend, and then they've been returning capital to shareholders with repurchasing of stocks. Go to the ratios and metrics. Yeah, it ain't no tech company, that's for sure. No, got gross margins around like 20 to 30%. Moderated, went down here recently a little bit to 22%. We'll probably see a rebound of that eventually as inflation tames, hopefully, and the macro environment improves. Profit margins kind of got a nice steady profit margin increase through the kind of COVID boom, and then decreasing or regressing back to the mean. So maybe we dip down a little bit more and then come up and eventually come back into this more stable area of profit margins around 5-6%. Yield metrics, we can kind of see the bottom line yields, free cash flow yield and earnings yield on a quarterly basis over time. Historical dividend payouts, looks like they may have just increased their dividend payouts. So dividend payouts have been steadily increasing. Enterprise value versus market cap, we can see they have carried, it looks like, probably a little bit amounts of debt over their cash consistently, balancing that out. And then we can see it kind of increased a little bit here. So we'll see. I would expect that debt to be paid back, them to kind of put some of their cash flows towards that debt in the future, along with dividends and buybacks. But they're going through a little bit of a cyclical time where They had a boom, a bust, and now they're moderating back. Revenue and gross growth, really good growth over the last 2 years, although it has moderated from 2021 to 2022. Historically, it looks like they've been right around 3-4% or so, with a couple down years. Dilution buyback yearly, we've got 2.25 or 2.5% buyback, 2% buyback, 3.3% buyback, 3.2% buyback. So really good amounts of buybacks. So they are taking advantage of basically returning capital to shareholders via buybacks and via dividends. So see dividend growth has been pretty consistent around 3%. So they've been giving small bumps in dividends, and then they had a fairly large 18% dividend increase over this last year. So analysts are estimating that revenue, EBITDA, and basically the bottom line metrics are all going to increase this next year. Sales, insider transactions, got some sales, lots of awards, some sales, lots of awards. So pretty balanced. But it looks like the insiders are keeping more than they're selling. So that's good to note. Go over to the evaluation template. On a yearly basis, we can kind of see the bottom line yield spread between what the security is yielding to the bottom line, the company is yielding to the bottom line versus the 10-year treasury. There's been a decent amount of time where it was between this 5 to 10%, probably 7% area. Buybacks, we see right here again. So on a 5-year basis, they've had bottom line growth of 13.8%. EBIT yield spread has been 6.2%. 5-year net yield spread has been 4.49%. Free cash flow yield spread has been 5.62%. Let's go into the valuation. So I've got a 10% base CAGR with a 2.5% margin of safety. Dividend yield is going to be 2.3%. So on just a price basis, equity price basis, we're looking at a target CAGR of 12.5%. If we look at 10-year treasury risk-free rate scenario, it's sitting at about 3.45. I've got my very bearish risk-free rate at 4.87 and very bullish at 1.99. Bottom line growth, we're going to be targeting over the next 5 years anywhere from 7 to 13% between the various scenarios. EBIT yield spread is going to be anywhere from 7.2 to 6.21. Very bearish, 6.21 and very bullish. Net yield spread is going to be 5.25 and very bearish to 4.49 in the very bullish. Free cash flow yield spread is going to be 6.57 in the very bearish to 5.62 in the very bullish. And that kind of gives us an overall yield of bottom line yield of 11.23 to 7.43 across the various scenarios. And that kind of puts us in this range from kind of 11% to 7%. So kind of would be right in line with the historical averages. And obviously, if we can buy the security when it's yielding 11%, we have more opportunity for multiple expansion and the price to increase that way. All right, with all of those assumptions, we have a 5-year target of the very bearish scenario of $134 per share. Bearish scenario is $162 per share. Base case is $198 per share. Bullish case is $244 per share. Very bullish case is $306 per share. In order to get our target 12.5% CAGR just on the price, not taking into account dividends. For the very bearish scenario, we'd have to buy at 174, which is in that range. The bullish scenario, I would have to buy at 139, which it's not there yet. Base case 113, bearish case 92, very bearish 76. So really, I'd probably be looking at this more in the 113 to $92 area on a 5-year chart basis. Yeah. I mean, we'd have to get back to probably COVID highs or so, which is definitely possible. I mean, just looking at the evaluation where it's traded historically, it could either go down if it's going to revert to the mean. It would either go down or it trade sideways until those bottom line fundamentals increased to where the yield metrics were more in a historical average. So what we're going to do is we're going to put this into the watch list. Go right there. And we will go ahead and keep an eye on it, see if it gets there. So, well, I hope you enjoyed this video. If you did, please like and subscribe, and I'll catch you in the next one. Thanks.